Hello everyone and welcome back to the channel. Why smart investors are quietly buying Palantir. Most people are looking at the wrong metric, and that's exactly why some investors think Palantir might be one of the most misunderstood stocks in the market right now. While headlines focus on hype, valuation, or short-term price swings, a quieter group of investors is watching something else entirely. And it could explain why they're accumulating shares while others hesitate. What Wall Street focuses on versus what retail misses. Let's start with the disconnect. What Wall Street usually focuses on: revenue growth acceleration or deceleration, operating margins and cash flow, government versus commercial revenue mix, stock-based compensation dilution, and forward guidance and valuation multiples. Now institutional investors are constantly asking, is growth sustainable and is it profitable? They care less about hype and more about predictability. Now let's compare that with what many retail investors focus on. This is what retail investors often miss: the stickiness of Palantir's contracts, the long sales cycles that delay visible growth, expansion revenue from existing customers, platform adoption inside organizations, and AI infrastructure positioning rather than AI hype. Retail investors often want fast, obvious growth, but Palantir's model doesn't always show results immediately. The company spends years embedding its software deep into organizations, and once it's inside, switching becomes expensive and difficult. That difference in perspective creates a gap and sometimes opportunity. Here is the metric most people ignore. Many investors obsess over headline revenue growth, but smarter investors are paying attention to customer depth and expansion. Palantir doesn't just sell software licenses, it builds operational systems that companies and governments rely on to make decisions. That means customers often start small and usage expands over time. Also, revenue per customer can grow significantly. This creates a land and expand model. If you only look at quarterly growth percentages, you might think momentum is slowing. But if you look at average revenue per customer, deployment scale, and long-term contracts, the picture can look very different. In other words, short-term growth may look messy. Long-term adoption may be strengthening. Why some investors are buying quietly? There are three big reasons. Number one, AI infrastructure positioning. Palantir isn't just an AI story, it's an operational platform that helps organizations use AI safely and effectively. Many investors believe the real money won't come from flashy AI demos, but from companies that make AI usable at scale. Number two, government relationships. Government contracts can be slow, but they tend to be durable. Once software becomes mission critical, contracts often expand rather than disappear. Number three, profitability shift. For years, critics said Palantir couldn't be profitable. But as operating margins improve and cash flow stabilizes, some investors see a company transitioning from story stock to execution stock. That transition is often when institutional interest grows quietly. Now, let's look at the strongest arguments from the bulls. AI tailwind. If enterprises rush to integrate AI into workflows, Palantir could become a core infrastructure provider. Also, high switching costs once deployed. Palantir software becomes deeply embedded. Replacing it can be risky and expensive. Also, operating leverage. If revenue grows faster than expenses, profitability could scale quickly, which tends to re-rate valuations. And lastly, strategic positioning. The company sits at the intersection of defense, enterprise software, and AI, three sectors with massive long-term spending. The bullish view says the market still underestimates how large this opportunity could become. Now, let's look at the bear case on the other side of things, because every investment has risks. There's valuation risk. Even strong companies can be bad investments if investors pay too much. Slowing growth. Concerns: if commercial growth doesn't accelerate meaningfully, the market could lose patience. Another thing is customer concentration. Heavy reliance on large contracts means revenue can appear lumpy and unpredictable. And finally, competition. Big tech companies and emerging AI platforms are all competing for enterprise budgets. The bear argument is simple. Great story, but execution and valuation must justify expectations. So here's my verdict. Palantir is not a simple growth stock, and that's why opinions are so divided. If you're looking for fast, predictable growth quarter after quarter, you may be disappointed. The business model is complex, the sales cycles are long, and results can look uneven. But if you believe that AI adoption will require secure operational platforms and that companies embedded deep inside government and enterprise workflows will benefit, then it makes sense why some smart investors are buying quietly. The key is this: Wall Street tends to focus on near-term numbers, and retail investors often focus on hype. The opportunity, if there is one, sits somewhere in between. Whether Palantir becomes a long-term winner depends less on headlines and more on execution over the next several years. And that's exactly why the smartest money isn't shouting about it. They're watching, waiting, and positioning. If you found this breakdown helpful, hit subscribe and let me know in the comments. Are you bullish or bearish on Palantir, and what metric are you watching most closely?